The rand briefly moved below 7.20 against the US dollar yesterday as the dollar came under pressure following poor jobs numbers and soft sales from big retailers last month. What's really been driving the rand is the so-called carry trade, with strong inflows to South African equities and bonds this year. For a look at how this has affected the bond market as well as some of the economic data out over the past few days, we're joined now by Vivienne Taberer, Portfolio Manager at Investec Asset Management. Vivienne, very good afternoon to you.
Good afternoon.
Well, Vivienne, perhaps starting just with those bond inflows, because we have seen lots of foreign interest in our bond markets this year, and that's being blamed partly for the rand's strength, or credited rather for some of the rand's strength that we have seen. Of course, the rand yesterday going to 7.20. How's that been reflecting in bond prices?
I think we have seen relatively reasonable bond strength. The curve has certainly flattened. We've seen the 10 to 15 year area of the curve flatten quite substantially on the back of longer interest in the longer dated end of our curve from foreigners. But I mean, this year has really been the year for flows into bond markets, emerging market debt markets broadly, and it's not just our market, it's right across the emerging market universe. In fact, if we look at sort of assets under management in terms of hard currency and local currency debt, we're looking at assets under management increasing by about 30% this year, so huge flows.
Vivienne, I mean, you're saying it's not just us, it's other emerging markets as well. You know, it seems that foreign investors are trying to take advantage of better yields, government finances as well, which are relatively good here in South Africa, and healthy offshore demand, which is filtered through into South Africa quite extensively. You're talking about assets under management when it comes to the bond market increasing around 30%. You know, where do you see this going from here onwards? Because at some point we should be reaching saturation level. At least that's what many economists out there think as well.
Yeah, I mean, obviously there's some shorter term flows that are a little bit more vulnerable to a turnaround in sentiment again. But I think actually what we're seeing here is a massive secular change in terms of how foreign investors are looking at emerging market debt. It's a low yielding world out there for developed market debt. Emerging market debt on balance is still giving you very good yields. In fact, the benchmark that we follow on our funds is still yielding around 660, which if you compare that to developed market yields of just over 2, it is pretty attractive. And then if you look at South Africa against that backdrop, even in the emerging market context, South Africa is a high yielder. So it's certainly not something that's going to change over the shorter term. Sure, we might see some of those flows turn around in the event of another bout of risk aversion, but I think quite a lot of this money is there for the longer term.
Of course, just a month or so ago, the markets were pricing in the possibility of a cut in interest rates. Of course, we didn't get that cut at the July meeting. Is the market now looking at a cut in the September meeting? And particularly just given where the rand is at the moment, so the government would like to see that a little bit weaker.
Yes, I think the economic data is a little disappointing. We are recovering, but it is a relatively slow recovery. That means that there's still going to be a door open to lower interest rates going forward. The market is pricing in a probability of around 40% of that happening in September. But even if that doesn't happen, we're looking at an environment where interest rates are likely to stay at these low levels for a prolonged period of time.
Looking at yield in South Africa, as you said, around 6.5%, do you think that an interest rate cut is going to have the desired effect, in other words, to try and weaken the rand and perhaps take away some of the foreign appetite that has been relatively aggressive over the last few months?
No, I don't think it would. At the margin, it might slow it a little bit, but it's certainly not going to change what is a major theme that's developing globally. And I think if we look at what's happening in the Reserve Bank, certainly we are seeing a sea change in terms of the way they're looking at the rand, looking at the volatility and the direction in which the rand is moving. But I don't think that a 50 basis point cut in interest rates is really going to have any significant impact.
Of course, Vivienne, we had golden forex numbers out this morning, and they showed that foreign exchange reserves rose by over $1 billion last month. Do you think there's a sign here that either the Reserve Bank or the Treasury have been accumulating more dollars and taking advantage of the rand's strength at the moment?
Yeah, we do know that they have accumulated a little bit more, but in relation to the size of the inflows that we're seeing, it is pretty small. I think there's still a debate out there as to how they would intervene and on what basis and to what kind of extent. But I think we are certainly starting to see tentative signs that they are concerned about the volatility and the strength of the rand.
Well, Vivienne, the rand breached that key 720 level in yesterday's session, and many are worried about the fact that we breached that key technical level, and now government has created a lot of discussion points. Of course, with regards to Tobin taxes, and of course the fact that we could be taxing capital inflows into South Africa. Do you think that would be the ultimate solution?
I think in terms of capital taxes and things like that, it's not ideally the way to go. But if you look at all other emerging markets, basically with the odd one or two exceptions, they all intervene in their currencies. So South Africa doing something along these lines, be it increasing reserve requirements, looking at taxes, using the swap markets, increasing reserves. These are all tools that central banks globally are using to try and not necessarily stop appreciation in their currencies, because there's good reasons why emerging market currencies should strengthen over time, but slow that appreciation and keep their currencies at less volatile levels.
Vivienne, what's in your view would be the most investor-friendly sort of intervention by the government?
I think talking about it quite openly is a good start. And then I think in terms of building reserves, yes, it might be expensive in terms of sterilisation, but you could also use forwards and swap markets, and those are probably the most investor-friendly ones. You obviously don't want a massive wall of money coming in and strengthening the rand too dramatically, but you also don't want to do something so draconian that you're going to turn those flows around and spike the rand up the other way. That's also not ideal for business South Africa.
Of course, we know that a lot of companies, a lot of manufacturers coming under pressure because of that strong rand, but we've also got to appreciate that the fact that the rand has been so strong, we've avoided importing some of those inflationary pressures, especially when it comes to oil. Where would you peg the rand where it's not going to be too dangerous on the inflation front, but also perhaps conducive for the manufacturing and other exporters in South Africa?
I think most people probably would be comfortable with a rand in the region of sort of sort of 7.80 to 8 against the dollar. So not hugely different to the levels that we are now, but certainly the rand is feeling a little overvalued at current levels.
Vivienne Taberer, we have to leave it there. Thanks very much for coming onto our show today.